Welcome, folks. Thank you for joining me, and thank you for sending all your numbers in, because I think I've got almost all the numbers for all the companies you're analyzing. And what I thought I would do today is actually use the numbers you sent me as a way of reviewing the whole class. So in terms of structuring the class, I'm going to actually make it part review, part so you can see what the numbers that you found for your company were. So let me start the show by going back to the very start of the class. The very start of the class, I said there were three ways you could put a number on your company. One is to do an intrinsic valuation, which I explained in glorified terms as you get the cash flows, the growth, and the fundamentals and drive value. But the reality after you try to value companies is when you actually try to do this as a mix of guesswork and estimation and hope that drives these numbers. It's intrinsic valuation. The second, I said you can price a company by looking at what similar companies are priced for. And already you can see how you pick a multiple and how you pick your peer group can give you a very different pricing. And finally, I said, if your company has contingent cash flows, it's a natural resource company with undeveloped reserves, a pharmaceutical company with a patent that right now is not viable, but could be viable in the future, you could use an option pricing as an add-on, not as a replacement for intrinsic valuation, but an add-on, something that gives you a premium. So ultimately, every valuation that you see out there has to fall into one of these three buckets. So what I'd like to start with today is actually a very quick review of the class structured as a set of questions for you. So along the way, we're going to hit pretty much everything we've done in the class, and I'd like you to help me out. So to kind of structure this discussion, I'm actually going to use a very strange construct. Have any of you read Dante's Inferno? I mean, you're required to read many undergraduate programs. If you take an English class, you have to read Dante's Inferno. Now, if you've ever read Dante's, if you've never read it, don't read it. It's a very, very disturbed book by Dante, of course, was an Italian in the Middle Ages, very Catholic. And he wrote a book about his visions of hell, all these sins that could get you into different layers of hell. So the entire book is about visiting hell. That's why I said don't read it if you haven't. But he talks about the kind of sin you'd have to commit to get to the first layer of hell and the second layer. So each sin takes you deeper and deeper into hell. So you know what I'm going to do? I'm going to take you into my own version of valuation hell by presenting you with sins and valuation. And if you commit those sins, I'm going to leave you in that layer. And if you don't, I'm going to bring you back. So I'm going to take you through each layer. And with each layer, I'm going to throw a question to you. And it's going to be a very fundamental, structured question. And we've seen the answers already. Let's see if you remember enough of this class to be able to come up with these answers. I'm going to start with what I call the base year fixation. So Parth, you're going to be my first visitor in hell. And you're going to leave if you give me the right answer, and you're going to stay if you don't. You're valuing ExxonMobil in 2009. And you look at the last 12 months, and the last 12 months for ExxonMobil, there's what the numbers look like. Their revenues were 58 million. Net CapEx was 3 million, CapEx minus depreciation. Change in working capital was 1 billion. So basically, the free cash flow to the firm in the most recent 12 months was $54 billion. Assume I know what I'm doing. This is actually the free cash flow of the last year. I also do my homework and come up with a cost to capital of 8% for ExxonMobil and a growth rate of 2%. Why is that equal to the inflation rate in the long term? None of those numbers look unreasonable, right? I've given you the free cash flow of the firm for the most recent year, 8% cost to capital, 2% growth rate in perpetuity. If you just stop with those three numbers, what would your intrinsic value for the company be?
You subtract the stable growth rate from the cost of capital.
So that gives me 6%. And in the numerator, what do you put?
In the numerator, you put your EBIT.
You put your free cash flow to the firm, right? The 54 billion. So 54 divided by 0.06 gives me $900 billion. The stock was actually trading at 373 billion. This must be one of the cheapest stocks of all time, or one of my three numbers has to be messed up, right? So which of these three numbers you think is the most suspect, the weakest link in my valuation?
Stable growth rate seems strong because you can't grow farther
Yeah.
than the economy in the long run.
If I'd used an 8% stable growth rate, you could have pointed that that's wrong. So clearly I'm not doing that. The cost to capital of 8% in 2009 looks reasonable. That was actually a little lower than the median cost of capital, which leaves you with only one number, right? The free cash flow of the firm. And what did I use? I used last year's free cash flow of the firm. Tell me the danger of doing that for an oil company, even if it's a mature company.
Oil companies do fluctuate greatly based on like OPEC's decisions and supply and like any.
Or what the oil price is, right?
Yeah.
The oil price is high, your earnings are high. The oil price are low, your earnings. So 2008 happened to be a really good year for oil prices. In fact, the price had already collapsed by the time I did this valuation. But because I was using the last 12 months, I was getting this number. It's not deceptive. It is the truth for last year. The mistake I'm making is I'm assuming that that will be the cash flow for the next year. You're saying, but I have good sense. I wouldn't do that. You're right. If you were thinking, what would you do? You'd replace last year's number with an average across time, reflecting oil prices over time. You'd use a normalized number. But the reason I bring this up, it's so easy to fall into what I call the base year trap. And I'll explain how this plays out. When you valued your individual companies, you took the last 12 months numbers and you put them into the spreadsheet, right? And as you were entering the spreadsheet, you knew these were last year's numbers, but somewhere along the way, you forgot about it. And those numbers become almost facts. I don't know how many emails I got from people saying, my reinvestment rate is, my sales to capital ratio last year is 3, and I'm getting crazy numbers using that in the future. And I said, why are you using that in the future? I said, because that's what it was last year. Think of how often our answer to why are you doing that is because that's what it was last year. Let go of what I call the base year fixation. Remember that time existed before 2020. Was it 2019 to 2018 to 2017 to 2016? Your job in valuation is not get anchored in the last 12 months data, but make your best judgments for the future. Now let's get to a more mechanical question. Nick, you're going to help me out on this one. It's a very simple mechanical question. So I come to you with a company and I show you its financials. EBITDA of 140 million, DA of 40 million, so EBIT is 100 million, interest expense of 20 million, gives me taxable income of 80 million. My tax is 32 million, giving me net income of 48 million. That is from last year. Oh, by the way, this company is in stable growth with a 0% growth rate forever. So whatever it made last year is what it's going to make in the future. Your task is a very simple one. Tell me what the free cash flow to the firm would be for this company, given what I've given you from last year's financials and expectations of future growth.
Hey. No.
First, because it's free cash flow to the firm, are you going to start with net income or something else?
Sorry.
You want to start with, I'm sorry, I didn't hear you. What's your measure of income you're going to start with if you want free cash flow to the firm?
Operating income.
Okay, you want to start with EBIT. EBIT is 100 million.
Yeah.
But you want to get after-tax EBIT, right? So here's your first challenge. What tax rate are you going to use to come up with your after-tax EBIT?
The effective tax rate.
And in this case, what's that effective tax rate going to be?
It's 80%.
The taxes are 32. The taxable income is 80, right? 32
I'm
divided
sorry.
by 80.
I was looking. I'm sorry. I saw 30. I'm sorry. I looked at the. It's 32%. Yeah.
Is it 32% or is it 40%?
It's on the taxable income. Yeah, 42%. True.
40%. So first thing to remember when you do free cash flow to the firm is don't get caught up in what the taxes actually are. You got a computer tax rate, in this case 40%, and you're going to take the 40% out of the 100 million, which is a hypothetical tax. And you know why you need to do that? Because if you don't do that, you double count the tax savings from interest expenses. That 8 million you're saving, 40 to 32 million, comes from the fact that you have interest expenses. And because you're already counting that in your cost of capital through an after-tax cost of debt, you got to make sure the double counting doesn't happen. So your after-tax operating income is going to be 100 million minus 40 million, which is 60 million. But to get to free cash flow, don't I usually have to add back depreciation and subtract out CapEx and subtract out change in working capital?
Yep.
Why in this case can I skip that step?
Because you have already accounted for.
What did I say? What does it tell you?
There's
There
no
it is.
growth in perpetuity.
No growth in perpetuity, which means I don't need reinvestment.
Yeah, no.
Otherwise, this problem is unsolvable. Do you see why? Because if I didn't tell you that, then you'd have to have CapEx and working capital. You can't even compute the free cash flow of the firm.
True.
The only reason you're able to do that is because I assume there's no growth. So my free cash flow of the firm in this case is 60 million. None of the other answers is the right answer because of the additional assumptions I give you.
I see.
Any questions on free cash? So that's a mechanical thing, something that people get wrong all the time on taxes. Make sure you don't use actual taxes paid. Use the effective tax rate on the operating income. The third one, I'm not even going to put you on the spot because it's something that I think is more generally something you have to keep your eye on. When you sit down to do a DCF, and you decide how long your company will be able to grow at a rate faster than the economy. So let's say I gave you a company like Peloton or Zoom. What's your first reaction? These are amazing companies. They're going to grow fast. I agree. But for how long? And your natural inclination, these are the very best. I'm going to use them, give them 50 years of growth, 30 years of growth. And here's my cautionary note. If you look at the history of growth companies in the US, and this is actually a graph we saw way back in like the 12th to the 14th class. The median growth period for a growth company in the US is between 3 to 5 years. Think about that. The typical growth company sees growth fade really fast. This is actually a study that looked at growth at IPOs and how quickly that growth rate becomes equal to the growth rate of the sector, 3 to 5 years. So when I use a 10-year growth rate, which is what I use in my DCFs, and you say, why are you stopping at 10? My answer is, that is the 90th percentile. Of course, there are companies that can grow longer than 10 years, but if you do, that should be icing on the cake for me as an investor, not something I build into the value upfront. Now I'm going to get to cost of capital. We spent a lot of sessions on cost of capital. Remember, we talked about the risk-free rate, the beta, the risk premium, the cost of debt, the debt ratio. I'm going to show you a cost of capital calculation that I saw done for a company. I've changed the name of the company by a banker. And in this one cost of capital calculation, there are at least 5 mistakes he managed to make. It's amazing how you can make 5 mistakes in one calculation, but he made 5 mistakes. Let's see if you can spot the 5. And I'll describe what he did. And as I go through each step, think about what you would have done differently. First, to get a cost of equity, you need a risk-free rate. But here's what the analyst did. Instead of using the risk-free rate as it existed, he used an average risk-free rate over the last 10 years. He called it a normalized rate. He's saying rates today are low. I'm going to replace it with a normalized rate. So he's got a risk-free rate, which is normalized. Second, for his beta, he went to Bloomberg. He had access to a terminal, obviously, and used the adjusted beta for the company from Bloomberg. For the risk premium, he used a historical risk premium. Basically, he looked at the last 80 years of data. The service that he used was called Ibbotson and Associates. And the risk premium he got for the US, looking back at the last 80 years, was 5%. But this company was a small company. So using the same database, he came up with what's called a small cap premium. Over the last 80 years, small companies have earned about 3% more than the market. So he added the 3%. His overall cost of equity was 14%. I think he's made at least 4 mistakes just in that one calculation. I want to think about the 4 as I go to the rest of the calculation. To get the cost of capital, he needed a cost of debt. The company was not rated. So he threw up his hands and said, the company is not rated. I cannot get a cost of debt by using the rating. So what I'm going to use instead is a book interest rate. You know what a book interest rate is? You take the interest expense in the income statement, divide by the book value of debt. He came up with 3%. He did remember it had to be after taxes, but he used an effective tax rate to come up with the cost of debt by saying, that's what I'm using on my cash flows. I'm going to stay with the effective tax rate. And for the weights, he did use the market value of equity. Thank God for that. But on the debt, because it wasn't traded, he decided to go to the balance sheet and got a little carried away. He said, I'm going to be conservative. I'm going to count all liabilities other than equity as debt. So he included things like accounts payable, supplier credit, trying to be conservative. So he ended up with 50% equity, 50% debt, and a cost of capital of 8.05%. So Rodrigo, start me at the top and work down. On the cost of equity calculations, if you'd been doing the calculation, let's start with the risk-free rate.
Yeah. So
what would you have done differently?
This is a Brazilian firm, but is the valuation in dollars?
No, actually, I forgot to mention, it's a US company with 20% of its revenues from Brazil. So that's a good question to start. What currency are you doing the valuation in, right? It is in US dollars.
Okay.
So you want a risk-free rate in dollars. So start
I'll
with
use
the first
the current 10-year treasury rate
and tell me why I shouldn't be normalizing risk-free rates.
because you don't know, it's unpredictable, and you want to value the company as of today.
And if I don't invest in this company today, where am I going to invest my money? In something risk-free today, which is earning not 5%, but 3%. This is not a hypothetical. This is a real opportunity cost. So I should have just used the 3%. Let's move to the next one. This should be an easy one. On the beta, you used a Bloomberg adjusted beta. So get your arguments ready, because this is something you're going to run into this summer if you're working as an intern or if you're working in a regular job, because people are going to constantly use Bloomberg betas or regression betas around you. Tell me the 3 reasons why I should not be using a Bloomberg beta for my company. Or even 2. Yeah, go ahead.
Bloomberg just normalizes the regression beta with a 1.
Okay.
So,
So can I use the Bloomberg raw beta then?
No, because it contains a lot of noise from.
Okay, so it's a regression beta. So even if you didn't normalize it, it would be backward looking. It's noisy, and what's the last problem?
It's unlevered.
It's actually levered, but it uses the average debt to equity ratio over the last 5 years. It uses the company that used to be. So it reflects the mix of businesses you used to have and the debt to equity ratio you used to have, as opposed to what you have right now. It's backward looking, it's noisy, and it reflects the company that used to be rather than the company today. So what would you use instead? What do we use for all our companies? We used a bottom-up beta. We built up to a beta based on the businesses there.
Yeah.
So Rodrigo, you want to stay on for the equity risk premium? Tell me what you'd have done differently on the equity risk premium.
Sure. I'll use the implied equity risk premium for the U.S. market, and add the Brazil risk premium based on the value, based on.
Exactly. Do you see why? In fact, prepare your arguments, because again, you're going to be pushing against the conventional wisdom. You're going to use an implied premium because it's a premium today and it's forward looking rather than backward looking. And you have to bring in a Brazilian equity risk premium. Why? Because they get their revenues in Brazil 20%. The fact that they're a US company doesn't mean I can ignore that risk. What do you think about the small cap premium?
That's useless. I don't know why you added that.
And you're right. And you know what? The reason they use it is because historically, they're right. Small cap stocks have earned about 3% more than the market, but that's going back to 1927. Since 1981, there has been no small cap premium. Small caps have earned roughly what large caps have earned. It's been gone for 40 years. So why do you think people use it? Because that's what they've always done. So I'm going to use the current risk-free rate. I'm going to use a bottom-up beta. I'm going to use an equity risk premium that's implied with a Brazil component added to it. And I'm going to take out the small cap premium. So that's going to give me a very different cost of equity. And you're going to see in a moment what that cost of equity is going to be. Let's turn to the cost of capital. Roger, you're going to help me out here. The cost of debt that this analyst used was a book interest rate. Is that the right cost of debt to use?
I would be inclined to say no.
And tell me why. What should the cost of debt measure? In theory, what are we trying to capture in the cost of debt?
How much debt financing would cost the company beyond the current cost of debt?
Today and long term.
Today's
Remember, those 2 added words have to be brought there. It's a rate at which you can borrow money today, and it's a rate at which you can borrow money long term. So that's why we build up to it by starting with the risk-free rate today and adding a default spread. You know, the problem with the book interest rate is if I borrowed money short term, or I borrowed money when rates were much lower, my book interest rate is going to be way lower than it should be. It doesn't reflect the rate at which I can borrow money today. You know what his argument is going to be? It's not rated. So how am I going to get that cost of debt? So what would your answer to him be, given that it's not a rated company?
I mean, even if it's not rated, we can still experience inaccuracy in that value if it's not, you know.
Right. And is there a way I can attach a cost of debt for an unrated company that reflects a rate which can borrow money today?
You could use the Moody's just generalized framework. I guess that is the rating, but you could.
we know what Moody's uses to come up with the rating, right? The ratios they look at. You could look at the same ratios. You can make a judgment on what the rating should be. In fact, we did that with the synthetic rating, the interest coverage ratio, giving a rating. We knew it was an approximation, but we're saying this is much better than using a book interest rate. So I would replace that book interest rate with a cost of debt reflects what the company can be able to borrow at today. Which leaves me with one final question for the weights. What is this guy trying to do? Joe, he's trying to be conservative and count all liabilities as debt, right? Tell me what's going to happen. If I count all my liabilities as debt, what's that going to do to my cost of capital?
It's going to make it very disproportionate to what it actually might be in comparison to
Lower or higher?
higher.
You think so? Joe, what do you think? Do you think it'll make it lower or higher?
Yeah, I think it would make it higher because it would increase your debt to equity ratio, which would increase your beta.
Which will increase your beta, but then what else will change? Your debt ratio and your cost of capital will change. The net effect is God knows what, because both numbers will change. Your cost of capital could decrease most of the time. And this is counterintuitive. When you count all of the scrap as debt, you will actually push down your cost of capital. Because what happens, your cost of debt is so much lower than your cost of equity, you'll actually end up with a lower number, and that's not being conservative. This is a cost of capital that's wrong at so many different levels. I don't even know where to start. So here's what I did. I decided to go and clean up. I replaced the current T-bond rate with an actual T-bond rate. I replaced the Bloomberg beta with a bottom-up beta. I replaced the Ibbotson premium with an implied premium. I brought in a Brazilian country risk premium component that 20% of revenues come from Brazil. I added the country risk premium. For the cost of equity, instead of getting 14%, I got 15.68%, even though I've taken the small cap premium out. For the cost of debt, I actually used a synthetic rating to come up with a 6% default spread. Their true cost of debt is really 9%, even though their book interest rate is 3%. I used the marginal tax rate. Why do I use the marginal tax rate, Louis? Give me the spiels for why the marginal tax rate should be what you should use for the cost of debt and not the effective tax rate.
That one I don't know.
Anybody want to give that a shot? Why do we use marginal tax rates to get cost of debt rather than an effective tax rate? Jake?
Because it's the cost of borrowing if you're going to borrow today. And if you borrow today, you'd pay the marginal tax rate.
You don't pay a tax rate on interest expense, right? The interest expense saves you taxes. It doesn't. So where is it saving you taxes? So if you have $1 million in income and you borrow money to create $100,000 interest expense, tell me the mechanics of what's going to happen. What do you report as taxable income to the government? You're going to take $1 million in income, subtract out the 100,000. You're going to report 900,000 in taxable income. Think of where you saved on taxes, not on the first 100,000, not on the middle 100,000, but on the last 100,000. The reason we use marginal tax rates for the cost of debt is because interest saves you taxes at the margin. The effective tax rate is an average tax rate. So I use the 40% marginal tax rate after tax cost of debt of 5.4%. For the debt, I went back to just conventional interest-bearing debt and leases. No accounts payable, supplier credit. That's not being conservative. That's just being rash. I end up with a cost of capital of 12.6%, much higher than the 8.05% because I've brought in country risk. I'm using a bottom-up beta. I'm reflecting a much higher cost of debt, but it's a much more realistic cost of capital for a company. The next time you see a DCF valuation done, I don't care whose name is on the top, McKinsey, KKR, Goldman Sachs, check out the cost of capital calculation. Take it through. You know enough now that you can ask the right questions. And you'd be amazed at how many screw-ups there are on something that should be pretty straightforward, at least at this stage in the process. Now, Tim, I'm going to come to you. You're now valuing a company. Let's say you go to work for an appraisal firm, Duff & Phelps, and you're given a task of valuing a company. And when you value especially smaller companies, often the management of the company will supply the numbers to you, revenues, costs, net income. So basically the argument is they know more about the company than we do. So we're going to ask for management forecasts. So I'll be the manager, you be the appraiser. And I'm going to give you what I'm projecting for the company. And your job is to make sure that I've not screwed up in my forecast. Now, remember, you directly challenge managers and say they're wrong. That's not going to be a great place to start, because I'm going to say, I know the company, you don't. So when you look at these numbers, think of some of the questions you would ask whenever you see forecasted cash flows. Let's start at the top. I've used a 10% growth rate forever. What might be some of the things you'd look at to see if I'm being unreasonable in that growth rate?
Probably if that 10% is plausible, considering like
And that's exactly right. So what are some of the things to measure plausibility?
probably like
Let's start with history. What's one of the things you might want to check in history? You might look at my 10-year growth rate over the last 10 years, and that's 2%. Then you're going to push me and say, what's changing? Is there a new product? Is there a new service? So one is historical growth. The second is, would you look at the size of my company and the size of the market? Might that play a role in whether 10% is plausible?
yeah.
If I'm a very big company in a mature market, the 10% might be, hey, you're saying that's too much. How the heck are you going to get 10%? If I'm a small company in a big growing market, 10% might be more plausible. It's exactly the question you ask about your own valuation. You look at a revenue growth number, right? You look at the size of the company, you look at the growth rate and say, is that plausible? So let's say the growth test, I passed the growth test, 10% is plausible. What's the next question you need to check to make sure my cash flow forecasts are not going to implode on me?
Well, I don't know if that growth rate of 10% can translates to the same growth rate for EBIT and other like capital expenditure.
In other words, basically you have to ask, am I reinvesting enough to get that 10% growth rate, right? And let me give you an indirect way of capturing that. Each year, if you look at my EBIT and free cash flow of the firm, year one, 33 million, free cash flow is 26.4. Year two, 36.3. And I know you can't do this in your head, but basically each year I'm reinvesting about 20% of my earnings back into the company. My reinvestment rate is 20%. My growth rate is 10%. Can you use those two numbers to kind of frame what I'm assuming about the future returns on projects I'm going to make?
Well, growth is 10% and then reinvestment is 20%. Basically saying my reinvestment, my return on capital is 5%.
50%.
Yeah, 50%.
Right?
Yeah.
And you now have me on the spot, right? Because if I'm assuming a 50% return on capital, you're going to ask me, what was your return on capital last year, 2 years ago, 3 years ago? And it said it was 9%.
That does make sense.
And you're going to hand my numbers back to me and say, hey, no, I'm not taking issue with your growth rate or reinvestment. Those two numbers don't coexist in the same valuation. This is, I think, something we need to do more with forecasts, because we let people forecast whatever they want. They're going to basically make the best of all worlds. They're going to grow fast, reinvest nothing, and get oompa loompa valuations. And you're pushing back and saying you can't do that. Now we're going to play a game that a lot of analysts play called the target debt ratio game. And here's what they will do. They'll take a company. Let's say its debt ratio is 10%. They say the target debt ratio for this company is 30%. And we're going to play this out. So Shaurya, you're going to be you're going to help me out here. I am looking at Hormel Foods. Right now they have 10% debt, 90% equity. Their cost of capital is 6.8%. But I said, look, your cost of debt is so low. You should be using more money. So I decided to go to a 30% target debt ratio. So if I go to a 30% target debt ratio, how would I recompute my cost of capital? Just tell me the mechanics of what I would need to do.
So the weights would change. So the cost of equity
so it'll be 0.3 and 0.7, right? What else will change?
The beta.
And tell me which direction it's going to go.
It should go up.
Because after unlever and relever, if I go from a 10% to 30% debt ratio, my beta will be higher, my cost of equity is going to be higher. What about the cost of debt? Do you think the banker will lend me money at the same rate if I triple my debt?
No.
The cost of debt will also go up, and you might have to do a synthetic rating and a higher cost of debt. The one thing you cannot do is just change the weights and leave the cost of equity and cost of debt unchanged, because then you're going to get this magic of every time I increase my debt ratio, my cost of capital is going to go down. whenever you change debt ratios, make sure you adjust the beta to reflect the higher debt and the cost of debt to reflect the higher risk. Otherwise, you're having your cake and eating it too, and you cannot do that in valuation. So I don't have a problem with people using target debt ratios. I do have a problem with all they do is change the weights and leave everything else as is. Now we're going to get to the terminal value. Okay. And Louis, I'm going to put you back on because this one I think you can help me out on. This is an easy one. And I'm going to make it more difficult as you get the first part. You get in every DCF, let's start off, and we know that the biggest number in your DCF is your terminal value number. And there are three ways you can get a terminal value. One is to assume a constant growth rate forever, that perpetual growth equation. The second is to apply a multiple of EBITDA, multiple of revenues, multiple of book value to get the terminal value. The third is to do a liquidation value. Now, when we talked about terminal value, I said one of these three ways should never be used in intrinsic valuation. Louis, do you remember which one of these three ways is a non-starter if you're doing a true intrinsic valuation?
The multiple, because that's a pricing. It's a pricing.
And by making my biggest number of pricing, what am I doing? I'm essentially losing control of my intrinsic valuation. It becomes mostly a forward pricing with this front of a DCF. Now, either liquidation value or perpetual growth models work. Most going concerns, we use a perpetual growth model. So Louis, help me out here in terms of numbers. Let's suppose I have a company, I get to year 10, and beyond year 10, I expect this company to earn $120 million in after-tax operating income every year forever. No growth, 120 million as constant. It's an all equity funded company, and the cost of equity is 10%. So what's my terminal value going to be? If I earn 120 million every year forever and my discount rate is 10%, what's my terminal value going to be?
There's no growth?
No growth, zero growth.
You still have to discount that back to the present value, right?
It's a perpetuity, right? Remember the formula for a perpetuity? It's cash flow divided by the discount rate. So 120 divided by 0.1 will give you $1.2 billion. Let's say I let you grow these cash flows at 2% a year forever. What would the value become then?
120 divided by 0.8.
0.08?
0.08, yeah.
But be careful, what's in the numerator? $120 million in after-tax operating income, right? The reason I let that be my cash flow when I had no growth is when I have no growth, I don't need to reinvest. If I put in a 2% growth rate, you know what I need to do to make sure that my valuation stays consistent? I need to reinvest enough money to deliver the 2% growth rate. When you change growth in your terminal value equation, you have to adjust your cash flows to reflect the fact that you need to reinvest to grow. In fact, if I have to reinvest at a 10% return on capital, you know what a 2% growth rate will do? Absolutely nothing. Why? Because I'm earning exactly my cost of capital. If you don't believe me, try it out with the numbers. Take 120 million, net out the 20% reinvestment rate, which is what you'd need with the 2% growth rate. Divide by 0.08, your terminal value will stay unchanged. It goes back to the point of growth has value only if you earn more than the cost of capital. That's why we don't play games with growth rates and terminal value. When you change the growth rate, everything else has to change to reflect that higher growth rate. In fact, in my DCF, I let you change the growth rate in perpetuity. But you know what? I force you to reinvest to get. So that's why when you change the growth rate, the value doesn't change money. You're saying, what the heck is going on? I changed my growth rate from 1% to 2% to 3%. Nothing is happening. You know why nothing is happening? Because your return on capital is close to or equal to your cost of capital. Sebastian? Charles, right? You prefer to be called Charles or Sebastian?
No, I go by Sebastian.
Okay, Sebastian. Okay. So now you're going to help me out. This is pure. I've done my DCF. I've come up with $100 million value for the operating assets. I'm going to list out 4 items. And with each one, I want you to tell me whether you'd add this item, subtract this item, or ignore this item to come up with the value of equity. So I've taken free cash flow to the firm, discount the cost of capital. I've got 100 million. I have a cash balance of 15 million. Add, subtract, or ignore.
I add that.
Add that and tell me why.
Add the cash balance.
Why do I add the cash
I mean,
balance?
you subtract net It is
I
cash.
subtract net debt,
you know,
add cash and subtract our debt. So why do I add cash?
because it is an asset, you know, it has value.
It's an asset as value, and its income is not part of my operating income. The reason we add cash when we do a free cash for the firm valuation is because we start with operating income, and the income from cash is not part of operating income. I haven't counted cash yet. When you do a dividend discount model, you don't value cash because the dividend discount model already starts with net income that includes the income from cash. It's because we start with operating income and we haven't counted cash that we add cash back. So we add cash back, we subtract our debt, that's a net debt. What if I have a 5% holding in another company? And that holding has a book value of 5 million, and the market value of the company is 200 million. Add, subtract, or ignore.
I would need to add that, yeah. Yeah, add
Okay,
that.
you're right. And in fact, let's think of why. Why do I need to
Because
add the
it's not
5%?
reported.
It is not
Wouldn't
part
it
of my
not be
operating
reported?
income. It shows up below the operating income line, so I've got to add it. We're almost home. So you add cash, you subtract debt, you add this minority holding. And then you look at the balance sheet and you see an item called minority interest, 10 million. Add, subtract, or ignore.
I subtract that.
And tell me why.
Subtract the minority.
Why do I
Because I
subtract
consolidated higher. In my consolidated statements, I had 100%, and I need to take out the percentage that I don't actually own.
You got it. These are the loose ends, right? You can already see why it's so easy because you let your guard down. You've taken free cash for the firm. You come up with cost of capital. You did all this work and you say, oh, thank God I'm done. And then you get sloppy. You add cash, subtract it, then the minority stuff, add this, subtract. It's so easy to screw up. And that's why at every step, once you got the free cash flow, question you got to ask is, have I already counted it? And if I haven't, I should add it. If I've counted it wrongly, then I need to correct for that miscounting. So when you look at the value of equity in the firm, it's what's left over after all of these claims. Now, would you answer final question since you got all 4 right? Now, let's say you come up with the value of equity. I think it's 95 million after all these adjustments. Add cash, subtract debt, add minority holdings, subtract minority interest. Would your answer change if I told you this company's been targeted in a lawsuit where they might potentially be required to pay out 100 million?
So that, yes, it would change, because when I set that cost aside,
And
yeah, I would
sense?
actually take that out from the equity value. I would already
And
take
to
that
take
out.
it out, you need one more parameter, which is what is the chance I will lose the lawsuit? If there's only a 5% chance I will lose the lawsuit, you'll subtract out 5 million, 5% of 100 million. If there's a 50% chance, this could devastate your equity value, right? 50% of 100 million. So when you are computing the value of equity, this is your last chance to clean up for everything that you worry about in a company. And that's why we look around and we make sure we double count. We don't double count things, because that's why we don't add the book value of things, the goodwill and the other variables, because that's already counted in, but we clean up for the things we need to clean up for.
Professor, how do you come up with a percentage on like lawsuits like that? How do you
Get a
usually
good I'll give you a facetious answer. You need a good trial lawyer friend, because I'll be quite honest that the US legal system leaves me completely mystified, right? Because it's not just one lawsuit, it's layers of lawsuits. A tobacco company might lose 5 billion in the first lawsuit, but by the time the appeals get done, it could be 5 million. It's a pure legal question as opposed to a financial question. There are actually services that go around trying to estimate these probabilities that you can use. And they're mostly composed of trial lawyers. Now let's close the loop. We've come up with the value of firm. We've come up with the value of equity for a firm. Let's say it's 200 million. Okay? And there are 10 million shares outstanding, and ask you what's the value per share. So that's obvious. 200 divided by 10 is $20 per share, right? So Nick, a value per share is $20. And then I said, oh my God, I forgot to tell you something. I gave away 2 million options to the CEO. But don't worry, the strike price is also $20. You see why I'm trying to bring in the strike price? Your value per share is 20. I've just given away at the money options. Do you think this might affect your value per share? Will it, and if it does, will it lower it, increase it? What do you think the effect will be?
I expect it to be right, Nick.
Yeah, go ahead.
Okay. So like essentially you have to add the value of $20 plus, but then you all have to divide by the outstanding. So it would be like 200 plus 2 million times 20, right? 40 million divided
If
by.
you do that, you're going to end up with $20 per share because that's the treasury stock approach where you add the proceeds, the numerator, in which case you're going to buy into my argument that this is not going to hurt you. But what am I missing when I use the treasury stock approach? Is an at the money option worth nothing?
No, it does have, yeah, true.
It has a value.
Because of
And that's why the right way to do this is what should I do? I should be subtracting the value of the options from my 200 million. And guess what that's going to do? It's going to reduce my value per share from $20 per share to $19.50 or $19.40 every time companies give options in the company to others, managers, suppliers, consultants. It is a share of your equity that's being given away. There is no free lunch here. We're deep in the layers of hell. So I'll leave you with the deepest layer of hell. I know that you don't remember this page, but at the start of session 4 or 5, maybe session 4, I brought up this company called Kennecott that was buying a company called Congolium. And First Boston was the investment bank valuing Congolium. And remember what they did? They projected out the cash flows for Congolium, the target company. And the cash flows they projected were after debt payments. Now, if you're discounting those cash flows, they're cash flows to this company, the target company, and they're after debt payments, you know what discount rate we need to apply, right? First, cost of equity or cost of capital? It has to be cost of equity. Why? Because they're after debt payments. And Alex, you can answer this one. Whose cost of capital should I use? Acquiring company or target company?
The one of the acquirer.
Acquirer. One of the acquirer, really? After the class we did on M&A, you're still going with the acquiring company's cost of, it has to be?
Because the cash flows will then eventually come to them.
Oh, no, you can't use that reasoning. Cash flows have their own risks. Just because they come to a safe entity doesn't make them safe. You could be the safest company in the face of the earth. You start a streaming business like Disney did. Guess what the cash flows in the streaming business are going to look like? Disney can be a safe company. The streaming business cash flows are going to be risky. The right discount rate should reflect the risk in the cash flows, not the risk in the entity looking at the cash flows. It should actually be the target company's cost of equity here that should have been used. But what did First Boston use? There's the acquiring company's cost of capital. Just a reminder that big name valuations can have fundamental, this is failing valuation 101. Big name valuations can sometimes screw up on very basic discount rate questions. So now I'm going to show you what you found in the class. So let me start off by showing you, let's make sure that I have the right slides here. The companies you value. The most valued company in the class was Shopify. First time I think a Canadian company has been on top of the list, followed by Spotify, Square, PayPal, Nike, Neo, Zoom, and it says Neo again, but basically not. There's a company called Bilibili, which is a Chinese company, which showed up 3 times. But my point is there are lots of companies that were valued by more than one person. And often I'm asked, why aren't you restricting a company to be valued by only one person? You know why it doesn't matter to me that 3 or 4 or 5 people value the same company? Because your numbers are never going to match up. Just to show you, there were 5 Spotify valuations, 4 were buys, 1 was a hold. Look at how different the DCF values are, ranging from $197 to $248. Same company, saying, how can they be different? You already know the answer, right? Who picked your growth rate, your margin, your sales to cap? It wasn't me, it was you. Those choices will give you different values. In the case of Square, you had 2 sells, 1 buy, and 1 hold on the company. And you can see why. Values, the DCF values are actually not that. The DCF values range from $45 to $208. You see why the price is different? You did it at different points in time. You can see you can have the same company with very different valuations. I could have given the same company to everybody in this class. And if you each did your own valuations, I can almost promise you that as long as you're not just turning in the same spreadsheet, you're each trying your best, that each of you will get a different number. And if you showed this to an actuary, an engineer, you know what their response is going to be? This is what's wrong with valuation. You can't even agree on a number. No, this is what's right about valuations. We can't agree on a number. You know why we can't agree on a number? Because it's all in the future. We all have different judgments we make, even though we start with the same base year numbers. So the first thing I asked you to do was a DCF valuation. And here's what you found. You found pretty much your median company was overvalued by about 27%. The average was actually overvalued by 56%, but the reason the average is so much higher than the median is there were a couple of companies overvalued by 300, 400, 500%. About, I think 67% of you found your stocks to be overvalued, 33%. So 1 in 3 found their stocks to be undervalued, 2/3 found it to be overvalued. Is that typical? In a typical semester, about, you look across time, there's about 50 to 55%. Half of the people find the company to be undervalued, half tend to be overvalued. But this number varies across time. And we're in a semester, both my MBA class, where 70% of the people found stocks to be overvalued. In your class, more people are finding their stocks to be overvalued than undervalued. Hold on to that thought, because we'll talk about what that might mean for the future. So more of you found your stocks to be overvalued than undervalued. But there were a few of you who did find undervalued stocks. Now, as I show you this list, remember all those disclaimers you see in investment banks saying, this is not my list. If you do something crazy based on this, it's not my fault. I'll add those disclaimers. These are just your valuations. And these were your most undervalued companies. Who did the Green Bay Packers? Yeah. Because the Green Bay Packers were the most undervalued company. The reason if the person were here, I'd have asked what the question I'd have asked, right? What's the biggest enemy of valuations? Bias. I'll tell you something. If I value the Yankees, there is zero chance you will ever find them overvalued. None. I love the Yankees too much. I'll find a way to. So the question I'd have asked is, are you a Packer fan? Green Bay Packers are publicly traded, and you can see $722 value, $300 price. You must assume that they're going to be able to re-sign Aaron Rodgers and win 3-4 Super Bowls in the next 5 years. But if you love a team, you can estimate all of those. The rest has a lot of names that I don't even recognize. But if your company's name is on this list and this is your valuation, you're going to get an email from me sometime in the next week. And this email is no points, no grade attached to it. And it's going to have only one question. You know what the question is going to be? Are you buying? And no dancing around saying, I don't have the money to do it. I don't feel certain right now. I have exams to prepare for. And the reason I ask that question is every semester that I've taught this class, I bought one stock out of the most undervalued list. And the only condition I require is you come along on the ride with me. And I promise you, I won't take it out on you if the ride is not a good one, the stock doesn't do well, because that's the nature of the process. But every semester, that is my investment back in the class saying, look, if I don't believe your own valuation, then I clearly haven't done it. So if you're on this list, expect that email. And if you're buying, you might want to reach out and say, I am buying this stock. It's on the most undervalued list. And here's why, because then I'm more likely to come along for the ride. Here were the most overvalued stocks. The most overvalued stock was Occidental. Whoever valued Occidental decided the DCF value is 0. In fact, there were at least, I think, 9 or 10 companies with the DCF value of 0. And these were companies where the value of the operating assets was less than the value of the outstanding debt. So it's not uncommon. You can come up with that conclusion. So these are the most overvalued stocks. So Shopify makes this list one of the most overvalued stocks, value DC. But remember, there were a couple of other people who found Shopify to be undervalued and put a buy recommendation. You got to live with that contradiction. Different people have different views in the company. So these are the most overvalued stocks. So this is the DCF valuation, undervalued and overvalued. But ultimately, the test of this is, does it really work? Are the stocks that you find to be undervalued really stocks that do better than the market? Now, I've been tracking the undervalued and overvalued stocks from this class going back a long time. And I give time because I'm not going to track the 2020 recommendations and see what they did because it's too soon. So if I take the 1995, spring of 95 recommendations, look at the undervalued versus the overvalued, the buys versus the sells, your undervalued stocks did much better than the overvalued stocks, and the average fell somewhere in the middle. And that's pretty much been the pattern through time, though there's variation over time. On average, there is information in what you're finding in your valuation. But the question is, can I use that information to make money? On average, you're right. About 60% of buy recommendations make money, but 40% lose out. So not everybody gets a buy recommendation right. About 45% of sell recommendations actually beat the market. So you're wrong about 55% of the time on sell recommendations as well. No, I'm sorry, 45% of the time. So there is noise. Nobody's perfect. None of these recommendations are perfect. The excess returns you make from buy recommendations tend to be higher for small cap and low profile companies. There seems to be more information, a buy recommendation you put out in a company where I look at the names, I've never heard of that company, which makes sense, right? Because you might be bringing something into the valuation that people are not seeing. It's a little less clear to me that the buy recommendations on big names like Netflix and Facebook and Google have the same degree of payoff because everybody kind of tracks these companies. Third, on average, I've made money on the recommendations in this stock, but that's on average. And the reason on average I make money is because the big winners make me a lot of money. And I bought Apple in the late 90s. I already owned it, but it was one of the most undervalued stocks, I think, of 99. I bought Apple, and over the next 10 years was up, what, 10,000%. What I'm trying to say is in investing, you're not going to be right on every single stock you buy. You just have to be right on the big winners to make up. And this is a portfolio that seems to have a lot of big winners. And finally, those stocks that came out as both undervalued and underpriced, because remember I asked you to make both judgments, tended to do better than stocks that were just undervalued or just underpriced. And the reason I bring that up is often people make this an either or. Are you doing intrinsic valuation or pricing? And my response is, why do I need to pick? I'm a believer in intrinsic valuation, but I see no reason why I can't price the stock as well. Because if something is undervalued and underpriced, I get a double whammy, both things working in my favor. Louis?
Yeah, I just have a question about the first bullet point. When you say 60% of buy recommendations make money, is that beating the market or?
Yes, beating the market after adjusting for the market. So it's not just going up. Going up is too weak a test. They go up by more than the market does. So 60% beat the market of the buy recommendations, but so do 45% of the sell recommendations. So that's where the noise in the recommendations come in. Now on pricing, I suggested a 4-step test to make sure you're not wandering off. The first step I said, when you look at a multiple, is make sure it's consistently defined. You know what I mean by that? If the numerator is an equity value, the denominator has to be an equity value as well. If the numerator is a firm or an enterprise value, the denominator has to be a firm or an enterprise value as well. So PE ratios are okay. Price to book works. EV to EBITDA is okay, but price to EBITDA doesn't fly. And then I said, just because you think you know what the PE ratio is, don't assume that when you're talking with somebody else about a PE ratio, that you're both talking about the same thing. I know it sounds simplistic, but say my definition of PE is I took the price per share today and divided by the earnings per share in the last 12 months. And the other person might say, my definition of PE is I took the price per share today by average earnings per share over the last 5 years. Very different PE ratios. Get the facts on the table before you start discussing, is that a high number or a low number? Third, don't be using multiples because you want to be lazy. And a lot of people use pricing because they don't want to make assumptions about cash flows, growth, and risk. But guess what? If you're paying 50 times earnings for a company, you're assuming high growth in the future, whether you like it or not. That's why we spent the time with those intrinsic models for multiples to make sure you saw that embedded in every multiple are assumptions about cash flows, growth, and risk. And finally, no matter how hard you try, you're never going to find companies just like yours out in the market. Think of how much trouble you had when you did pricing for your company, deciding what should go in your peer group. And even after you were careful, you still had big differences in your company. You might have used a regression, but the bottom line is doing pricing in that last stage requires a lot of subjective judgments. So somebody says, DCF, you're making assumptions, pricing, I'm not. That's not true. You're making a different set of assumptions. You have to ask, which one am I more comfortable with? So yes, so if you remember now, this is a page we did in pricing. Every pricing is embedded, every multiple is embedded in it, assumptions about cash flows, growth, and risk. And when I use that, discounted cash flow model to figure, it's not the model itself that matters, the variables that come out of it. So PE ratio is a function of growth, payout, and cost of equity. Price to book, growth, payout, cost of equity, and return on equity. Every multiple, knowing what the variables are that drive the multiple, give you the tools to ask the right question. And I try to sell you something based on that multiple. So I'll let you pick whatever multiple you wanted to, right? And if you look at your breakdown, here's what you ended up picking. About 60% of this class picked some version of an enterprise value multiple. So more enterprise value multiples than equity multiples. And a lot of revenue multiples. You know what that tells me? You got desperate. There are a lot of money losing companies. You discover the PE ratios don't work evenly. So especially after year like 2020, it doesn't surprise me that you were climbing up the income statement. Is that wrong? No. Pricing is about convenience and being pragmatic. I can understand what's going on. PE ratios still hung in there. 22% of companies use PE ratios, 10% use price to book, and there were other multiples. I don't know what they are, but you could essentially divide your market value by any number, right? Market value per number of subscribers, market value per number of users. I don't know whether any of you did that, but some of you might have done that. And when you looked at the pricing itself, I basically did a very simple comparison of what you came up with as a price per share for your company as opposed to your own DCF value per share. You know what the results showed? Take a look at the median value, because that I think is the most meaningful number. For the median company, the DCF value was about 95% of the pricing that you came up with the company. For the typical company in your class, at least, your DCF value was lower than your pricing by about 5%, which actually I expected to see. And here's why I expected to see it. Earlier on, when I talked about what percentage of stocks came out as overvalued, I said 65% of you found overvalued companies, 35% found undervalued companies. You know what that tells me, right? If you do a pricing, about half of companies should come out as undervalued, no, half should come out as overvalued. I expect to see that your DCF value is going to be lesser than your pricing, but not by much, about 5%. That doesn't mean for some of your companies, the pricing wasn't higher than the value, but for the typical company, the DCF value was lower than the price. So here's what your most underpriced stocks were on a relative basis. The Packers still stay there. Somebody really loves the Packers, right? But your most underpriced stock was Lyft. Now, I'd be curious. I haven't seen the details as to what Lyft was being priced against. If you price Lyft against Uber, it's actually clearly underpriced. If you compare Lyft to car service companies, you see already that this judgment you're making in pricing is always going to be a function of who you're comparing it to. So it's the same. If I asked you, are you fat? I'm not trying to insult you, but if you compared yourself to people who are on Weight Watchers, then you might say, look, I feel pretty thin, because you have a selection bias. People on Weight Watchers tend to be overweight. Of course, you're going to look thin. Same thing applies here. Take the pricing with a grain of salt, because it's a function of both the multiple and the comparables. Virgin Galactic, I was shocked to see Virgin Galactic look underpriced. I don't even know what you compare it to. I mean, after all, it's not easy to find comparable companies when your core business is taking people to Mars. But maybe against other entertainment companies or large entertainment companies, Virgin Atlantic looks cheap. So when you're doing pricing, the multiple matters, the comparable matters, and here are your most overpriced. Occidental is on top of the list again. Incidentally, you know that Occidental was Warren Buffett was a shareholder in Occidental till a year ago. He sold it in March of 2020, I think. But it's interesting, it's showing up as both the most overvalued and overpriced stock in the mix. And the rest are a mix of companies. And most of them, you're not surprised to see it. NVIDIA, Tesla, these are among the most highly priced companies in the sector. And you see them showing up as overpriced. Now, for a few of your companies, I did ask you to apply an option pricing model. But there are two conditions I said you should look for to apply an option pricing model in your company. One is I said, see if your company is losing money. And then I said, see if your company has a lot of debt. Because if you're losing money and you have a lot of debt, I argued you have a liquidation option, an option to liquidate your company. And what it allows you to do is pay a premium on top of your DCF value. There were 23 companies in all. I don't remember 200 and something companies. So it's only 1 in 10 companies. So if none of the companies in your group had an option pricing model, don't be surprised, because 1 in 10 companies, and actually I think 2 or 3 groups or 2 of the 5 companies had option pricing components. It's not common. But for those 23 companies who used an option pricing model, the premium that you got from using an option pricing model was about 36% above your DCF value. So if your DCF value is $10, your option pricing model gave you $14. The additional value comes from the uncertainty about the future, helping you as an equity investor in the company. Now, one final point, and this goes back to the last class, we were talking about enhancing value. And I said to enhance value, you've got to change the way a company's run. And when you change the way companies run, the only way to figure out how much your value goes up is to go back into your DCF model and put in those changes, higher margins, less reinvestment, whatever your changes are. But that's a lot of work, right? So a lot of top management at companies don't like DCF models. They think they're too complicated, too complex. So consultants have known this for a long time. So if sold managers a bill of goods, they go to them with a metric and say, if you adopt this metric, then you're going to increase that. That metric, 50 years ago might have been increased return on equity. Return on equity going up is good for your company. And that's true, right? Holding all else constant. But over the last 40 years, consultants have come up with these proprietary metrics that they claim are better at enhancing value than traditional ones. And they charge a ton of money to companies using these metrics. And they're sold as magic bullets. Just do this and you'll become more valuable. And these metrics are all shortcuts. None of them is a bad metric, but by itself, you're adopting a shortcut, because in the full valuation, you got to look at everything. They're saying, just look at this one thing. So I'll give you an example of 2 metrics that were created, one in the 1980s and one in the 1990s. In the 1980s, a company called Holt Associates created a metric called CFROI. Think of it as an internal rate of return on your cash flows as a company. And they told companies, you want to earn a high internal rate of return. Kind of makes sense, and more than your cost of capital. So that's the CFROI. The other measure was invented in the 1990s by a company called Stern Stewart. And the metric they came up with is called economic value added. And I'm going to give you the definition of economic value added. And you tell me whether there's anything surprising or new in what they did. So here's what they did. They took the return on capital and subtracted out the cost of capital. So the first stop they made with CEOs is make more than your cost of capital. And companies said, amazing, I'd never have thought of that myself. And they said, if you can make more than 5% more than your cost of capital, it's better to make that on $1 billion than $100 million. And companies were again amazed. I said, that's good. If I make that excess return on more money, that's better than less money. And for providing this mind-boggling advice, Stern Stewart became one of the most sought-after consulting firms of the 1990s. At one point, half of all of the S&P 500 companies were paying Stern Stewart money for this incredible advice that they should be making more than their cost of capital. And if they can do it on more money, it's better than less money. And Stern Stewart was actually run by 2 guys called Joel Stern and Bennett Stewart. And in the 1990s, they were incredible salesmen. They went around and they convinced CEOs of companies that this was the magic. EVA was going to make them successful. Now, Bennett Stewart was one of the 2 people who founded the firm, was a master salesperson. He could sell refrigerators to Eskimos. And he'd show up at CEO conferences with a prop. And his prop was a Coca-Cola annual report. And here's what he would do. And in the 1990s, Coca-Cola was peak success. This is what success looked like in a company for other people, because it was growing, earning well above its cost of capital. Its market cap was soaring. Everybody wanted to be like Coca-Cola. So Bennett would put up the annual report for Coca-Cola. He'd turn to CEO and say, do you want to be like Coca-Cola? And all the CEOs say, yes, yes, we'd like to be like Coca-Cola. So Coca-Cola uses EVA. Remember those logic classes in high school? A leads to B, B leads to C, A must lead to C. Everybody says, oh, amazing, amazing. I say, if you want to be like Coca-Cola, all you need to do is pay us to bring you EVA. It's amazing how many people signed up. So I happened to have the misfortune of being on the panel with Bennett Stewart a couple of times. The first time I got blindsided by this Coca-Cola annual report. So I said, I'm going to be ready next time this happens. So the next time I'm on the panel, I know exactly what prop he's going to come up with. I came up with my own props. So he stands up, he says, do you want to be like Coca-Cola? Here's the Coca-Cola annual report. Everybody says, oh, we'll all take EVA. Then I got up. I didn't say a thing. I had my prop. I put it up. It was a pair of Nike Airs, Air Jordans. I held it up and say, do you want to be like Michael Jordan? And say, yeah, everybody. In the 1990s, who didn't want to be like Michael Jordan, right? 6 NBA championships. Michael Jordan wears Nikes. You can see what the last step was, right? Then I'd stop and I'd sit down and people say, what the heck is he doing? I'd take off my shoes, put on the Nikes. Say, can somebody point me towards a basketball hoop? I'd like to slam dunk a basketball. You know what my chances of slam dunking a basketball are? They're less than 0. I could slam dunk a basketball maybe on a Fisher Price. You know, one of those little kids' basketball hoops? In fact, I used to keep one well after my kids stopped playing so I could go and slam dunk a ball. There's 0 chance. I can wear the most expensive Nikes in the world and eat all the Wheaties in the world, and I'm not going to be able to slam dunk a basketball. But my point is, just because you adopt EVA, you're not going to be Coca-Cola. In fact, Coca-Cola's success preceded them adopting EVA. They were a successful company. Why? Because 100 years ago, somebody came up with a syrup that somehow connected with people and they had a great brand name. This has nothing to do with EVA. So my point is, when people say, well, we've come up with this new metric to value companies, don't believe it for a moment. It's old wine in a new bottle. There are no new ways to value companies. This is extensions of old ways. There used to be a time when I used to ask people to do EVA on their companies as part of this project. I said, what a waste of time. Why am I asking people to do this? It's adding nothing to the process. So let's say you've gotten to the final point in evaluation. You valued your company, you priced your company, you compared the price. Remember what I asked you to do? I said you have to make a recommendation. And the reason I force people to make recommendations is I want them to get through that fog of uncertainty. You know what I mean by that? When you finish valuing a company or pricing a company, you're saying, but I feel so uncertain. I'm not sure yet. If only I collected more information, did more research, maybe I will get more certain. It's not going to happen. You have to cut through that uncertainty and make a choice. And some of you might decide that you're never going to be able to make that choice. You will not have faith. Remember, I used that word faith. It will not come. Don't fight it. If that's what happens, put your money in index funds, go live the rest of your life. But if you do decide to have faith, couple that faith with humility. In other words, don't take the most undervalued stock you have and put all your money in that stock. You spread your bets. No matter what Mark Cuban and Charlie Munger say, it's beyond stupid to take the 3 best stocks and put all your money in it when you could take the 10 best stocks and spread your bets out. It's not a sign of weakness. It's a sign of strength to say, look, I can be wrong and markets might not adjust and I have to spread my bets. You don't have to be right on all 10. If you're right on 6 out of 10, or even 3 out of 10, but one is a super winner, you'll end up looking good on your overall portfolio. So I asked you to make a recommendation. And here's what he came back and told me. I think the number of buys, I can't even see it, was 87. The number of sells was 116. So the number of sells outnumbered your buys by about, and in fact, I've computed ratio. The number of buys was about 80% the number of sells. The number of sells exceeded the number of buys. But that's changed over time. In fact, there have been times in the past where the number of buys exceeded the number of sells. It happened in 2000 after the dot-com bust. It happened in 2009 after the 2008 crisis. It again happened in 2012. But we're actually at a number that is well below 1. One way to think about it is maybe this is a signal about the market overall. That's what you're getting when you look at these recommendations. I am not at a position of faith enough to make a bet on the market based on what you're discovering this overall statistic. But as I said, I track it over time. And over time, there is at least a rough relationship between what this statistic looks like and what the market does in the subsequent years. We are in a very richly priced market. And that's what you're seeing in evaluations. Doesn't mean we should all get out of stocks now, not necessarily. But it does suggest that caution should be the byword when you invest in a market like this one. So as you think about whether you want to value something or price something, remember, 2 things are going to come into play. One is, what are you trying to put a number on? If you're trying to put a number on a baseball card, if you're trying to put a number on Bitcoin, remember, all you can do is price those things. You can't value them. You got to price them. But if you're trying to put a number on a stock, of course you can put a value. But whether you do so will depend on who you are as an investor. It'll depend on your time horizon. The longer your time horizon, the greater the likelihood that a value makes sense to you. It'll depend on why you're doing the valuation. If this is your job, don't be crazy and do a DCF because that's what you believe in. Your job might require to price things, in which case you should be pricing them. Finally, it's also going to depend on what you think about markets. In what sense? Every investment philosophy is built on a presumption of how markets make mistakes and how they correct their mistakes. If you believe that markets never make mistakes, go buy index funds. If you believe that markets make mistakes on average and they correct them over time, do discounted cash flow valuation. If you think markets are right on average but are wrong in individual stocks, do pricing. Every approach has a belief about markets. So I'm going to show you a question. I did show you early in the class, and I promised I would give you another chance to answer this question because I showed it very early in the class before you'd actually valued and priced companies. Now that you've actually had a chance to value companies and price them, I'm going to ask you the same question. Now that you've seen the different ways of putting a number in a stock, if I pushed you to put a number in a stock, which of the following 3 are you going to use? A discounted cash flow valuation of the stock, which requires an intrinsic valuation, a pricing of the stock, we're going to look at a multiple and comparables. Are you going to say, look, I don't think I have a chance of finding undervalued or overvalued stocks. I'm going to take the current market price as the best price I can get for the stock, which is a belief in efficient markets. I'm not saying, so don't view it as failure if at the end of this class you've decided that valuation is not something you have enough faith in to actually put money on. That's never been my objective. If you feel that you now understand enough about valuation that you want to avoid doing it, that is actually a very healthy response that could potentially save you a lot of money. And one final point, remember that link that a good valuation is a bridge between stories and numbers. If I have some advice for you, it would be to work on your weak side. If you're a natural storyteller, work on getting better with numbers. And even though they make you uncomfortable. If you're a natural number cruncher, start giving your imagination a chance to tell stories. Be kind to yourself as you tell these stories because it will not come naturally to you. So I'm going to leave you with a few final points. Every time markets change, you're told this time will be different. These things don't matter anymore. Let me remind you again that the fundamentals always matter. It's always about cash flows, growth, and risk. Now we can attach different prices to risk. Premiums might change over time, but you can never tell me cash flows, growth, and risk don't matter. Second, this is a process where it's so easy to get distracted by tiny little details. Always step back and look at the big picture. That's why I try to fit my valuation in one page where I can see all of my assumptions all in one place. Because if I let them get split up among 10 different spreadsheets, it's very easy to get distracted. Third, when you go to work, you're going to have this 65-year-old analyst tell you, I've been doing this for 40 years. Trust me, I know what I'm doing. Don't trust him. He has no idea what he's doing or she. Because this is a process where experience doesn't seem to necessarily make you better. It just gets you more stuck in the same stupid things you've been doing for 40 years. Fourth, don't take any of this stuff too seriously. You know what stuff I'm talking about? Everything we've talked about in the class. Remind yourself, it's only a valuation. If your response is, no, it's only money. You say, what if your response is, what else is there in life? You might need some therapy, but I can't give you. Maybe you need to see a rabbi, a priest. Now, I remember about 15 years ago, at the end of one of these one of my MBA evaluation classes, a second year MBA comes up to me. Now, she's a history major from Yale who came back for an MBA. And usually if you're a history major from Yale, you take the strategic MBA route. You know what that is? You take every class with the word strategic in its name. You can go through 2 years of an MBA program without ever seeing a number, all Harvard case studies piled up on top of each other. She ended up in this class, which is not a strategic class. And she turned out to be really good at it. At the end of the class, she comes up and she says, I never thought this would happen, but I have a job as a sell-side equity research analyst. I said, my condolences. No, I said, congratulations. And then she said, I'm really scared. And I said, what are you so scared about? She said, what if I make a mistake? I said, be glad you're not a brain surgeon. A brain surgeon makes a mistake, somebody dies on the table. You make a mistake, what's the worst that's going to happen? Somebody gets a little richer, somebody else gets a little poorer. Just make sure that somebody who's getting a little poorer is not you. Think like a Marxist. You move some wealth around. The world hasn't ended. Move on. Nothing in valuation is worth having harsh arguments over or losing sleep over. So if it's Saturday night at 11:30, you're still at work, and this other person on your team wants to use a Bloomberg adjusted beta, just let him do it. This isn't where you want to draw a bottom-up beta. Just let him. Nobody's going to pass out because of that. And here's my final piece of advice, we can call it that. If you're ever given a choice between knowing everything there is to know about valuation and being lucky, guess which one you should pick? Pick being lucky. This is a game where luck is the dominant paradigm. If you're in the right place at the right time, I don't care how uninformed you are or how stupid you do things, you will still make money. If you're in the wrong place at the wrong time, it doesn't matter what work you put in to get there, you're still going to lose money. It's brought home to me by my mother-in-law when she came to visit in 2000, peak of the dot-com boom. She comes to visit. She would drive us crazy all day long. She would make this a spectator sport, turn on the TV, watch stocks, watch the ticker go at the bottom. And every time one of her stocks went, she said, go, Cisco, go, convinced it was actually pushing up the stock price. And all she would talk about all day was what she bought, what she sold, this was like a continuing conversation. And she thought I was interested, but I had to act like I was. I wasn't even listening. Then she let it slip that she owned a stock called Qualcomm. Qualcomm in 2000 was one of the great winners of the previous 2 years, up 400%. I was impressed. So I said, Judy, why do you pick Qualcomm? And I knew the minute I asked this question, I shouldn't have, because she told me. She said she picked Qualcomm because it owned MCI. And I said, that's not Qualcomm, that's WorldCom. She said, Qualcomm, WorldCom, what's the difference? I said, you bought the wrong stock. If you meant to buy the stock that owns MCI, you'd have lost 40%. So you buy some other stock that rhymes with it and you make 400%. I was afraid to ask her after that why she owns Cisco. Afraid the answer might be, I like Saturday Night Live, which is disco, or, vegetable oil, which is Crisco. Who knows what drove that particular decision? But after she left, I did try a strategy out, pick a stock in the news, pick one that rhymes with it. You know what? If I'd made a lot of money on that strategy, who cares about cash flows, growth, and risk and intrinsic value? We'd have been talking about rhyming stocks all semester long. It just didn't work for me. Be lucky. Because if you're lucky, everything else will kind of take care of itself. So if you find yourself that your stocks in your portfolio keep going up and you go to the same Starbucks and ordering a venti cappuccino, keep doing it. Don't mess with this kind of stuff. So on that note, I'm going to end the class. A couple of reminders. Your final exam is day after tomorrow. It will be available for 16 hours during the course of the day from 4 a.m. to 8 p.m. New York time. It's a 2-hour final exam. So don't forget the date, and I think I was told to remind you about your CFEs. It's something that was in the MBA class. If you don't do your CFE, you can't check your grades. They all do it. So Now, if you haven't done your CFEs, I think you have until tomorrow to get it done. I don't know what the consequences of you not doing it is, but I've done my job. I've reminded you. So that's about it. Nick, you have a question?
Yes, it's more of a comment, Professor. Just can you hear me?
Yep.
I just wanted to say, Professor, like it's been an absolute honor having you as a professor. I just want to say, like, one of the deciding factors of me coming to Stern was like
I am the one to see. Now you're putting this on me. So those of you unhappy with NYU, if I did it, it's not my fault. I don't even live in New York anymore. So, no. But thank
like
you.
Having the option to come here and like learn from you, Professor. Like, yeah, just absolute honor. Thank you.
It was a pleasure. I mean, I really enjoyed this. I enjoyed this class. Obviously, as a teacher, there's nothing I miss more than actually being in a physical classroom. I've always heard, I always used to hear Broadway actors complain about being in the movies. They said acting in a movie is not like being on Broadway. And it's true, right? Because you're on a camera. Here, I can't reshoot, but in a sense, it's not the same thing. But we have to live in the world we're in. Hopefully by next spring, I'll be back in the classroom, but you're not going to be repeating valuation, I hope, next spring. So it was a pleasure. Thank you. And thank you for, I know it's a lot of work in this class, and I really appreciate how much work you guys put in.
Thank you, Professor.
Thank you, Professor.
Take care.
Thank you,
Thank you.
Professor.
Thank you, Professor.
Thank you,
Thank you,
Professor.
Ajay.
Thank you, Professor.
Hey,
Thank you,
Professor.
Thank
I had a
you.
quick,
Take
I had a
care.
quick question.
Go ahead. Who's the
So
question?
when
Sebastian,
you
go.
mentioned Charlie Munger earlier,
Yeah.
very quick. You mentioned Munger earlier, so it can see. He always says, or him and Warren always go for a great company at a fair price versus a fair company at a great price. And then there's Howard Marks. He says the exact opposite. He'll always go for a fair company at a great price over versus the opposite. When it comes to your, obviously we're not stock pickers like Munger and Buffett. What do you what do you
I think the
about
price,
that?
I think I'd agree more with Howard than with Charlie or Warren on this one. At the right price, I will buy anything. And I own GE in my portfolio. I bought it at 7. And I said, you know what? I hate GE as a company, but at $7 a share, I think I'm going to make my money back. It's doubled in price. Now, I love Amazon as a company. There's no way I'm buying Amazon at 2,800. Maybe and maybe the point is, if I found a great company trading at less than the value, I'd be more inclined to buy it than an otherwise equivalent average company trading it below. But if you gave me a company that's priced 50% below value, another priced at 10%, it's no contest for me. I'll buy the company that's 50% below value. Yeah. So I think that the price matters more than any other aspect. You could have the greatest company on the face of the earth in your portfolio, but if you bought it at the wrong price, returns are going to reflect that, right? And that's why your greatest chances in investing come from a disconnect between what you think about a company and what the rest of the market thinks about a company. And I tell people, look, if you think a company is great and everybody kind of agrees with you, that should make you a little more cautious about investing in the company, because if everybody else agrees with you, they're already pricing it in. But if you bring up this company and people say, that's a terrible company, but you've done your homework and you really think under the surface, and it could be a boring, terrible company, but under the surface, you think this company has the ingredients for that. That's a mismatch where you're seeing something that the rest of the world is not. Because without that, it's very difficult to actually make money in the market. That's why disagreements with the market are actually, and that's why when people said, no, I'm valuing the company, but I'm coming up with a very different viewpoint than the market. My point is, it makes you uncomfortable, but that's why we do valuation, because sometimes you can disagree, aggressively with the market, and you hope you're right, but you could be wrong, and you spread your bets. But if on average you're right, that's the kind of portfolio that's going to deliver much higher returns for you. And you also have to be careful, because great is a very fuzzy word. What does that mean, great? Because we all have our definitions of great. Kraft Heinz looked like a great company to Buffett and Munger in 2015. Why? Because it had a history, a long tradition of earning well above the cost of capital. Why do they earn more than the cost of capital? Because people love the brand name, Heinz ketchup and Kraft, the Kraft cheese. But the reality is that brand name was more prized by people 65, 70, and 75, not by 30. I mean, nobody says, look, if you don't give me Heinz ketchup, I don't want this ketchup. People don't even like ketchup anymore. So I think that the problem with great and good often is that, we act like these are facts, but these are judgments. And those judgments often reflect past history, what we think about the management. One thing about Buffett and Munger is they tend to kind of buy companies where they like the managers. There's very little activism on the part of, Buffett's been a stockholder in Coca-Cola. He's never pushed Coca-Cola to change the way they think about their business. And from that perspective, they bring less to the table than a Bill Ackman. You might not like the man, he might be unpleasant, he might get in your face, but he's trying to create change. And you have a far greater chance of saying, look, that's why I think you can make more money with a Bill Ackman than I can. So, I was saying, if you don't bring something to the table, you'll have nothing to take away. And more, when I look at old time value investing as Buffett and Munger describe it, the question I'm asking is, what are you bringing to the table? If all you're saying is buy quality companies and hold them, is the only thing you bring to the table a long time horizon? If that's the only thing you're bringing, that doesn't seem to be enough of an advantage to make money anymore. So I think that the world has shifted under Buffett and Munger. What might have worked in the 60s and the 70s. A lot of Buffett and Munger's investments were based on mean reversion. Things would revert back to the way they used to be. So you bought American Express in 64 because it is salad oil scandal. You said, this is a great franchise, it's going to come back. Mean reversion works when you're in the largest economy in the world where everything reverted back to the norm. That's what the US was. What I think the last 20 years have brought is these structural breaks, which means you might never revert back to a historical norm. And that's a very dangerous place to be if your entire investment strategy is built on mean reversion. Now, there's something good in almost what everybody says, but ultimately at the end of the process, you got to come up with your own version of a philosophy that you buy into, right? So that might take a little bit from Marx, a little bit from Buffett and Munger, and a lot of you, what makes you comfortable is ultimately the philosophy that's right for you. No. And I think that's the search for an investment philosophy that I think will lead you to a place where you can say, I'm comfortable with what I'm doing, even if the rest of the world is not, because this is what I believe.
Thank you.
Okay.
Yeah, it's the stomach. As Munger, just bring it back to Munger again. Half of it's the stomach, being able to take the.
Exactly. And remember, old time value investing was, the first rule was capital preservation. You start with capital preservation as one of your founding blocks for investing. It's going to lead, it's not a good or a bad thing, it's built in. Then it's going to lead you down a very different path than one that says mine is capital growth, right? Because it depends on what you use a portfolio. If you're building a portfolio for your pension, then you want capital preservation to be key. If you're building a portfolio because you want to get wealthy, it's a very different starting point, a very different end game. So I think a lot of what these philosophies end up doing reflects the starting point. What are you trying to do in the first place?
Thank you.
You're welcome.
Thank you very much.
Take care.
And also thank you for the semester too. Thank you very much.
Professor Damodaran, I
Yes.
have one final question if you have a second.
Yeah.
Yeah, I just wanted to say, first of all, thank you so much for the semester. To echo Nick, I had a Spanish study away classmate in 2017 that told me you have to take Damodaran at Stern. He's a legend, he's an icon, and you have been a legend. So thank you for that. My question was regarding Ethereum. I mean, recently there's been a lot of hype around Ethereum. A lot of articles are comparing it to be the silver of gold's Bitcoin, and its price is still relatively low, but I'm kind of skeptical of crypto as a whole. And I kind of wanted to ask your
I'll
opinion
tell you
on
what,
Ethereum
I think
specifically.
that you either buy crypto because you think there's going to be an end use for crypto. It's going to be used as a currency, or you buy crypto because it's going to be a collectible like gold. The end use part, crypto's not done a very good job of making a case. Why? Because people don't use cryptos for transactions. They don't buy houses. You're saying, but I do know somebody who does. The fact is everybody knows somebody. It's amazing. I was in front of a group of 1,000 crypto true believers. And I asked them, how many of you have actually used crypto to actually buy a coffee, eat lunch? And the answer was almost nobody in there for multiple reasons. One is the transactions costs are horrendous and they're not going to come down. There's no economies of scale. Bitcoin, for instance, this might not be true for Ethereum, is only going to get more expensive as you get closer and closer to 21 million, because you got to go through more and more mathematical gymnastics to check a transaction. If it's a collectible, it's a different question. The question is, will it have lasting? So people have to want this 20 years from now, 40 years from now, 60 years from now. Now with gold, we know what makes it a collectible. It's got 5,000 years of history. You can point to that people haven't lost interest in gold. Diamonds, the same thing. So the question I would have for whether it's Bitcoin or Ethereum is, what about this collectible gives it enduring demand? It's got to be demand that lasts. Yeah, go ahead.
On your first point, you have companies like Tesla that are buying tons of crypto in their portfolio. Does that not count as validity?
MicroStrategy and Tesla that have put cash in crypto. Neither is a case study that you want to follow. No sensible company that doesn't want to get sued should ever put cash. I mean, do you know of companies that put their cash in gold? They don't. And you know why? Because you don't want to hold a collectible in a company and have the collectible end up driving the pricing of your company. As long as things are good, people look the other way. So this is amazing. But if things fall apart, I can almost promise you there's a corporate governance nightmare here. Somebody's going to sue in court saying, how did the board of directors okay a $2 billion investment in Bitcoin for a company that is an electric car company? And for Tesla, it's doubly damaging, right? You got this great electric car story going. Why the heck would you want to contaminate its story by bringing in a Bitcoin part to it? So companies are not holding the Bitcoin as a cash balance. 2 or 3 companies are, but they're like, and I've also heard overstock except Bitcoin. You know what percentage of overstock transactions last year was actually transacted in Bitcoin? 0.2%. The fact that somebody adopts Bitcoin doesn't mean people are using Bitcoin. And here's why people don't want to use Bitcoin. Let's say you have 10,000 Bitcoin. You want to buy a house. What might hold you back in using the Bitcoin to buy the house? Let's say you use it today and Bitcoin goes to $150,000 to you. You basically have the FOMO factor, which is you worry that if you use the Bitcoin today and it goes up, you're going to end up looking back and say, I wish I hadn't done that. I'd have 3 times more money. So people don't want to buy with Bitcoin. On the other side of the transaction, people don't want to be paid with Bitcoin because they're not sure what the price will be tomorrow. That's why volatility has never been a good feature for a currency. You don't want a currency swinging all over the place. You can't buy with it. You can't sell with it. But the problem is it's designed in a way to encourage volatility. Bitcoin is run by people who make money trading Bitcoin, not by transacting Bitcoin.
Do you think it's going to be a bubble or just a volatility curve for indefinite?
I think it's, it might stay around, but you're going to see what you've seen over the last 2 years. Price will soar up, price will collapse, price will soar up. There'll be people who get rich, people who get poor. If you want to trade in Bitcoin, it might be a very good trading investment, but it's not a great investment, something you put your money in as a pension fund. It's not a great currency. You don't hold it because you want to transact with it. And I think if you want to price Ethereum, and that's what people are doing right now, is they're pricing cryptos against each other. And so Bitcoin looks cheap relative to, they all could be worth nothing, but basically the pricing game can still continue. And then you throw in the new coins, you throw into the mix, you're going to have all kinds of pricing ratios that people are going to use to justify, buying a particular crypto or not. But ultimately, if none of them has an end use, and none of them has lasting power, that's like saying our BD Baby's worth more than this, this, I don't know, Barry Bonds rookie card that I have. And at one point, Barry Bonds rookie cards were going for a lot. Today, you could just buy them for a fraction of what you pay. So I think that that's a problem with a collectible. A collectible to hold on to value has to have lasting demand. And I'm not sure there's anything. I mean, I'd rather put my money in a Picasso than in Bitcoin. At least I can look at the Picasso and say, look, it's an amazing painting. What the heck am I going to do with Bitcoin? Who am I going to show it to? I can't even see it in my own wallet. Yeah.
Thank you so much. Hope to meet you in person one day.
Yeah.
Awesome. Yes, I also had a very quick question, but before, at the risk of sounding too sappy, I also wanted to thank you for a great semester. Even back in like high school or so, middle school maybe. I just remember seeing you on CNBC.
You should be thinking about investing in middle school. That's not a very healthy admission, but no.
But it was great just watching you on CNBC explain things with such gravitas, and it's definitely continued well.
It's fake. I can pull off gravitas with a drop of a hat, but no, thank you though.
Mhm. Absolutely. I was wondering, on a bit of a fun note, you did mention that you invested in one of the most undervalued stocks every year when you taught this class. I was wondering, that portfolio of sorts, how has that fared? Has it been
No,
pretty
that's what that
positive?
graph was. Basically, it's delivered about 3 or 4% more than the market, but it's mostly because the big winners. It's not like every undervalued stock does well, but 1 in 3 is a big enough winner that it makes up for the fact that 40% of those stocks actually don't beat the market. So you have to hold on to the big winners, which is one reason you got to be careful about when you sell as much as when you buy. I mean, we spend so much time talking about when to buy stocks. We don't talk enough about when to sell. Knowing when to buy and when to sell, I think, is critical in collecting those aggregate returns.
Absolutely. I meant, though, more as when you email these students and ask how faithful they are if they're putting up their own money, do you find there's that relationship between the most faithful students and their stocks?
I don't know, but that's my condition is because I don't keep track of those who buy, those who say, because I buy only one of those stocks anyway. I should keep track of it because I usually don't know. I look at the one that I buy, but I don't keep track of who said they were buying and who said they weren't. Because sometimes it's good reasons. Not that you don't believe your own valuation, but you're an undergraduate. You have the tuition sucks up every dollar of savings you have. You say, what am I going to invest? I'm in student loans to $100,000 unless I borrow money and risk my entire future here. So sometimes I think that's a factor as well in why people don't put money behind their buys.
Absolutely. But, thank you again, Professor, and have a great summer. Hopefully we'll see you.
Thank you. Take care, folks.